Once a thriving giant in the Chinese footwear industry, Guirenniao, also known as the Shoe King, has faced a staggering downturn over the past 6 years, with losses exceeding 40 billion yuan and the closure of over 5,000 stores. Its storefronts have perpetually displayed clearance sales and 50% off signs. Meanwhile, the founder of Guirenniao, who once possessed assets worth 19 billion yuan, has now become a default debtor with a debt of 3.4 billion yuan. On the evening of February 1st, Guirenniao Co. Limited issued its first risk warning announcement about the potential delisting of its stock. On February 1st, 2024, the closing price of the company's stock fell to 0.96 yuan per share, dropping below 1 yuan for the first time. This puts the company at risk of being delisted due to its stock trading below its par value. According to the Shanghai Stock Exchange listing rules, for companies listed on the Shanghai stock market that only issue A shares, if the daily closing price of the company's stock remains below 1 yuan for 20 consecutive trading days, the company's stock may be forcibly delisted by the Shanghai Stock Exchange. As of the closing on February 2nd, Guirenniao's stock price had fallen by 5.21%, closing at 0.91 yuan per share, still below the 1 yuan delisting threshold. In addition to the risk of being delisted, Guirenniao faces performance and debt pressures. On September 22, 2023, Guirenniao previously announced that it would optimize and adjust its sports footwear and apparel business. It planned to dispose of assets relating to the Guirenniao and Prince brands and other sports footwear and apparel assets by licensing, selling, and leasing. The company intended to gradually exit the sports footwear and apparel business, focusing on the grain industry as its main future business direction. On January 27th, Guirenniao announced its performance forecast for the year 2023, indicating an expected annual loss with an estimated net profit of approximately negative 485 million yuan and non-recurring net profit of approximately negative 495 million yuan. Compared to Guirenniao's net loss of 9.41 million yuan in 2022, this represents a 50.5-fold increase in losses year on year. Guirenniao explained that the shortfall was primarily due to two factors: the macroeconomic situation and the substantial impairment losses and credit impairment recognized by the company in 2023. Guirenniao stated that in 2023, the macroeconomic situation in China was particularly challenging, characterized by insufficient market demand, and the company faced significant competitive pressure in both the grain and sports footwear and apparel industries, leading to a substantial impact on its operational performance. Guirenniao Sports Group was established in 1987, reaching its peak with over 5,000 employees and more than 5,000 brand-exclusive stores, generating an annual revenue of 3 billion yuan. Starting from 2016, Guirenniao's business deteriorated rapidly, with its stock price consistently declining. The company attempted to transform itself by acquiring retailers such as Mingxie and JZX Sports and obtaining agency rights for a significant number of branded shoes, including Nike, Adidas, and Puma. Additionally, it secured the exclusive operating rights for A&D1 basketball equipment brand in the Greater China region for 31 years. However, in 2018, Guirenniao suffered a massive loss of 686 million yuan, wiping out 5 years' worth of profits. In the first quarter of 2019, the company experienced a significant drop in revenue by 37.4%, with total liabilities amounting to 3.22 billion yuan. Over 6 years, Guirenniao has lost 40 billion yuan in assets and closed nearly 4,000 stores. From January to September 2022, Guirenniao generated revenue of 847 million yuan, marking a 27.6% year-on-year decrease. The net profit attributable to the company's shareholders reached a loss of 259 million yuan compared to a loss of 166 million yuan in the same period of the previous year. Simultaneously, Guirenniao's assets have significantly diminished, with net assets attributable to the company's shareholders decreasing by 55% year-on-year, leaving only 220 million yuan. The total assets also declined to 3.6 billion yuan. However, Guirenniao's total liabilities had surged to 3.4 billion yuan, resulting in a high debt-to-asset ratio of 93.5%. Due to Guirenniao's failure to meet its bond obligations and repay its debts, a court issued a restriction on consumption order requiring Guirenniao and its legal representative, Lin Tianfu, to refrain from engaging in high consumption and non-essential spending activities. As a result of 3 consecutive years of losses, in 2020, Guirenniao was first subjected to the risk of being delisted. On March 25, 2022, the Intermediate People's Court of Xiamen City, Fujian Province, issued a notice indicating that some of the shares held by the controlling shareholder of Guirenniao Group would be auctioned judicially. Subsequently, Guirenniao embarked on a restructuring and development strategy with changes in its actual controlling shareholders. Although it managed to remove the stock designation, the company still faced heavy debts and continuous market share declines. In September 2023, Guirenniao announced it would abandon its footwear and apparel business after 36 years and shift its focus to selling grains. In fact, as early as 2021, Guirenniao had partnered with Heilongjiang Taifu Jingguan Network Technology Company to promote its grain trading business. In China's sluggish economy, Guirenniao is not the only one sinking. Several well-known domestic brands in the memories of the Chinese people have been declining one after another. These brands include Guirenniao, Daphne, Belle Fashion, Ao Kong, Red Dragonfly, 361 Degrees, and even the so-called pride of domestic brands, Li-Ning and Hongxing Erke. In August 2021, Li-Ning, touted as the pride of domestic brands, briefly reached a market value of 268 billion Hong Kong dollars. By December 2023, in just over 2 years, Li-Ning's stock price plummeted by 83%, resulting in a market value loss exceeding 210 billion Hong Kong dollars. The fall of Li-Ning from its pedestal owes much to the actions of certain segments of Chinese consumers and netizens.
In October 2022, Li-Ning organized a winter fashion show to launch its new clothing line. However, a group of nationalistic Chinese internet users, often referred to as Little Pink or Xiaofenhong, accused the company of designing a set of clothing that resembled the uniforms of the Japanese invading army during World War II. They took particular exception to the hats, which they perceived as provoking Chinese national sentiments. In no time, China's online platforms were flooded with discussions and criticisms of Li-Ning, leading to a massive backlash.
The phrase, "I consider Li-Ning as a domestic brand, but Li-Ning sees me as a Jap," went viral and directly resulted in a loss of 12.3 billion yuan for Li-Ning within 3 days. What's more, some internet users even revealed that Li-Ning's current CEO, Qian Wei, is a Japanese-born Chinese. Qian Wei was born in China in 1971, went to Japan for studies in 1990, and graduated from Kansai University in Japan. Subsequently, he obtained Japanese citizenship and changed his name to Takasaka Takeshi. He worked for Uniqlo, a Japanese brand, for more than 23 years before joining Li-Ning Group in 2019. Conspiracy theories quickly emerged online, making Li-Ning a target and subject to boycotts. Despite Li-Ning's response to the controversy, its stock price continued to decline. On October 19, 2022, Li-Ning's stock price fell by 6.5%, resulting in a total market value of 138.8 billion Hong Kong dollars, a decrease of 9.6 billion Hong Kong dollars compared to the previous trading day. On October 20th, Li-Ning's stock price continued to drop, reaching as low as 48.55 Hong Kong dollars per share in the morning session. By the end of the morning trading session, it was reported at 50.35 Hong Kong dollars per share, representing a 4.9% decrease. The total market value was 131.9 billion Hong Kong dollars, which was 6.8 billion Hong Kong dollars less than the previous day. In just 2 trading days, Li-Ning's market value had decreased by 16.4 billion Hong Kong dollars. In reality, Li-Ning's company is primarily owned by Li-Ning and his family. Its Japanese-born Chinese CEO holds a very small stake in the company, less than 1%. The power of China's Little Pinks should not be underestimated. Within a few days, a company that was once celebrated as the pride of domestic brands and making Little Pink supporters proud was severely damaged by their patriotic fervor. When it comes to domestic brands, Chinese Little Pinks seem to have a tendency to either fervently support or vehemently criticize. In July 2021, a massive flood inundated Zhengzhou, Henan province in China. In the midst of this disaster, the struggling brand Hongxing Erke suddenly gained attention, and a bizarre farce unfolded over the following days. On July 21st, Hongxing Erke quietly announced a donation of 50 million yuan toward relief supplies to the flood-stricken areas of Henan. Such a show of support would not have been an issue, but Hongxing Erke's approach took an unexpected turn. On the evening of July 22nd, a topic titled Hongxing Erke's Weibo comments are so touching suddenly went viral, and soon after, Hongxing Erke's Taobao and Douyin live streaming rooms were flooded with internet users. In a short time, the viewership surpassed 1 million and in its peak even exceeded 8 million. The comments under the trending topic were along the lines of, "They were almost bankrupt, yet they donated so much," and "Let's buy more and support more domestic brands." This is where it became bizarre. Wild consumption erupted overnight, causing a buying frenzy for Hongxing Erke during their live stream. This long-struggling brand suddenly saw its sales performance skyrocket by an astonishing 52 times. In just one day, the total sales reached a staggering 22 million yuan, with multiple products sold out, setting a new sales record for the brand. People not only rushed to online live streams, but also flooded into physical stores. Many stores were quickly emptied, with some male customers buying over 30,000 yuan worth of shoes in one go. There were even reports of men buying 500 yuan's worth of items and paying 1,000 yuan, then running away, and instances of people stripping the clothes off the mannequins in a frenzy of wild consumption. Furthermore, whether one bought Hongxing Erke or not suddenly became synonymous with patriotism and a measure of one's character. However, 100 days later, when Hongxing Erke was again in the media, the tone had changed. Suddenly, the brand was losing nearly 10,000 followers every day and saw a significant reduction in foot traffic at stores. According to the reports, foot traffic in Hongxing Erke's physical stores had returned to normal levels, while the online sales situation was even less optimistic. During the same period, Hongxing Erke's official Douyin live streaming room saw a loss of 430,000 followers at a rate of almost 10,000 every day. Those who had advocated for wild consumption and declared that not buying Hongxing Erke was unpatriotic suddenly disappeared overnight. Meanwhile, the brand that had gained tremendous attention faced new challenges. First, the 50 million yuan donation was questioned as potentially fraudulent. Additionally, some pointed out that despite being touted as a domestic brand promoting patriotism, Hongxing Erke was actually wholly owned by a foreign entity. Furthermore, Hongxing Erke faced accusations of design plagiarism and subpar product quality. Some individuals also highlighted that Hongxing Erke's total liabilities had reached 980 million yuan, with multiple outstanding legal debts, such as owing Microsoft 500,000 yuan in intellectual property fees and owing a certain transportation company 190,000 yuan in freight charges, among others. In addition, there were claims on Baidu Tieba, an online forum, that Hongxing Erke had not paid its employees' wages. Some argued that as a business, Hongxing Erke should prioritize the interests of its employees, shareholders, and suppliers rather than using charity as a marketing tool to exploit Chinese people's patriotism. The following video is a critique of Hongxing Erke's use of charity as a guise for commercial marketing.
In November 2021, during the severe floods in Shanxi province, Hongxing Erke once again gained attention for donating 20 million yuan worth of relief supplies. However, this time, instead of sparking wild consumption, the brand faced severe backlash. Some criticized Hongxing Erke of secretly donating to the disaster-stricken areas. People accused the brand of using the disaster for marketing purposes. Some bluntly said that Hongxing Erke was trying to profit from patriotism once again.
In the eyes of China's little pink internet users, issues like donation fraud, product quality problems, unpaid debts to foreign companies, and unpaid workers' wages may not be significant concerns. What truly turned Hongxing Erke from a beloved brand to a controversial one was its exploitation of patriotic sentiment to profit from the emotions of these little pink supporters. In the case of Guirenniao's donation to the Henan floods in Zhengzhou in 2021, The brand also experienced the patriotic enthusiasm of Chinese netizens. In the face of a 300 million yuan loss that year and a 30 million yuan donation to Henan province, netizens flocked to their live streams and stores, sparking a temporary revival. The president of Guirenniao expressed in an interview the hope that people genuinely like their products rather than blindly consuming. The glass hearts of China's little pink have become increasingly fragile. Today, they may boycott Western brands, and tomorrow they may target Japanese and Korean products, as if the whole world owes something to the Chinese people. This presents an opportunity for many domestic brands. In recent years, the sportswear and apparel industry, in particular, has been adept at riding the wave of Chinese style. Brands like Anta and Li-Ning were even dubbed the pride of domestic brands. However, in 2023, these brands did not fare well. Over the past year, the Hong Kong-listed sportswear sector experienced several collective declines. Li-Ning, for example, saw its stock price plummet by as much as 80% within the year, with over 200 billion Hong Kong dollars in market value evaporating, making it one of the worst-performing components of the Hongxing Index this year. Xtep Shoes' stock price has also been in decline, with a 16.5% drop immediately after announcing its performance for the Double 11 shopping event, marking the largest single-day decline since March 2019. The same applies to Anta, with its stock price dropping from a high of 123.8 Hong Kong dollars per share to 70 Hong Kong dollars per share within the year. The reason for the overall decline in the sportswear and apparel industry is that the Chinese economy has slowed down, people's wallets have shrunk, and domestic brands have raised their prices while failing to improve their quality. Even Li-Ning faced questioning from many consumers for raising prices using the Chinese-style products as an excuse. With the cooling of the Chinese-style trend, sportswear and apparel manufacturers that have relied on this trend to create demand find themselves in a dilemma of how to sell their products. In the first half of 2023, Anta had an inventory turnover speed of 124 days, a decrease of 21 days compared to the previous year, but inventory still amounted to 6.5 billion yuan. On Li-Ning's side, in the first half of 2023, inventory reached 2.1 billion yuan, a year-on-year increase of 7.25%, and inventory turnover days increased from 55 days in 2022 to 57 days. Brands even resorted to deals like 4 for the price of 1 and over 70% off. Fads will always come and go, and not all brands that promote themselves through patriotism can make consumers willingly part with their money. Even Little Pink supporters who may shout patriotism with their mouths, but are practical with their wallets. Today, Guirenniao sells grains and pre-made meals, while Xtep, Li-Ning, and Anta have ventured into the coffee and hotel businesses. While these may be survival strategies in a challenging economic environment, the future remains uncertain, and they may not have full control over their destiny.